You've seen this happen, right? A headline flashes across your screen, record earnings, and then you watch the stock price just tumble. It's a paradox that makes you scratch your head, and it trips up a lot of people. Well, here's why. That headline number, especially in a market that's priced for absolute perfection, is often just an illusion. And right now, with analysts forecasting a massive 14 to 16% earnings growth, that illusion is more dangerous than ever. It creates a razor-thin margin for error. So today, we're going to pull back that curtain, and I'm going to give you the tools to see what everybody else misses. And that curtain, it really separates two totally different ways of thinking. This quote just nails it. You see, Wall Street is obsessed with those quarterly reports. They build these incredibly complex models, they set price targets, all based on hitting those massive growth forecasts. But the best CEOs, the ones who are actually building businesses that last, they're playing a completely different game. They care about the real cash the business generates over years, not just some accounting number at reports for 90 days. And in today's market, understanding that difference is everything. So, if we can't always trust that big, flashy earnings number, especially when the stakes are this high, what do? How do we become smarter investors? How do we uncover the real story of a company's health, buried under all the hype? Well, that's our mission today. We're going to go way beyond the headlines and build a detective's toolkit so you can spot the truth in a company's finances, especially when the whole market is walking a high wire, expecting nothing less than perfection. Every good investigation starts somewhere, right? There's always that first lead. And in finance, that's almost always earnings per share, or what we call EPS. It's the number you hear shouted on every financial news channel. It's the metric that can send a stock soaring or crashing in a matter of seconds. It is the absolute star of the show. But, like any seductive clue, it can be dangerously misleading if you don't understand just how fragile it can be. Okay, so let's break it down to the basics. EPS is actually a pretty simple calculation. You just take a company's total profit, that's its net income, and you divide it by the number of shares that are out there on the market. Simple as that. So if a company makes, say, $10 million and it has 10 million shares, its EPS is $1. This is the number that gets all the attention every quarter. It's the number that has to meet or beat what the analysts expect, or else, look out below. And this right here is the critical distinction. A positive EPS tells you one thing. Yes, the company is making a profit on paper. And look, that's important to know. But being profitable by itself doesn't automatically make something a good investment, especially not when that profit is already priced in by the market's sky-high expectations. Think of it as just one piece of the puzzle. To see the whole picture, you've got to ask, okay, but how much am I paying for that profit? All right, so if profit isn't the whole story, what's our next move? Well, we have to connect that profit to the price tag. This leads us to the second clue in our investigation, the famous price-to-earnings ratio, or PE ratio. This is where we start to figure out if all the market excitement is actually justified or if it's just pure hype. The easiest way to think about the PE ratio is like a price tag for profits. It doesn't just tell you the price of one share. It tells you how many dollars you have to shell out for every $1 of profit the company makes. So if a stock costs $50 a share and its EPS is $2, it has a PE of 25. That means you're paying $25 for every single dollar the company earns right now. See, it gives us some much needed context. Is this thing expensive or is it cheap compared to its own earnings power? All right, time to put on our detective hats. Take a look at this. We've got two huge, well-known companies. Company A has a PE of 14.4. Company B is just a tiny bit higher at 14.9. I mean, they look almost identical, right? So based on this one clue, how on earth could you tell which one is the better value? The truth is, you can't. We're paying almost the exact same price for their current profits. We are clearly missing a key piece of evidence here. So what's the missing piece of our puzzle? The clue that's going to crack this case wide open? It's growth. The PE ratio tells us about what a company has already earned, but we, as investors, are paying for what a company is going to earn in the future. And in a market obsessed with a 16% growth forecast, figuring out the price you're paying for that future growth, well, that's everything. And this brings us to the PEG ratio. This is a total game changer for our investigation. It takes that PE ratio we were just looking at and it puts it into the most important context of all, growth. It forces us to ask the real question. Am I overpaying for this company's future? This little ratio brilliantly connects a stock's price, its current profit, and its expected growth, helping us see if the story Wall Street is selling actually makes any sense. What makes this tool so great is how simple it is. It's just a 3-step process. First, find the PE ratio. We already know how to do that. Second, find the company's estimated future earnings growth rate. That's that all-important forecast number. And third, you just divide the PE by that growth number. So, for example, a company with a PE of 20 and an expected growth rate of 10% has a PEG ratio of 2. But a company with that same PE of 20 but a growth rate of 20%, it has a PEG of 1. The key takeaway here is that a lower PEG is better. A ratio under 1 is generally considered a fantastic sign. Why? Because it suggests the company's earnings are growing faster than what the market is currently pricing in. You're basically getting more growth than you're paying for, a potential bargain. On the other hand, a really high PEG ratio is a huge red flag. It might mean the stock is way, way too expensive even after you factor in its future growth. You're paying a massive premium for a story that might not even come true. So let's go back to our little mystery. Remember Company A and Company B? Well, it turns out that Company B, even though it had a slightly higher PE, was projected to grow its earnings by 15% next year. Company A, only growing at 5%. That one detail changes everything. It gives Company B a PEG ratio of just under 1, while Company A's is almost 3. All of a sudden, the picture becomes crystal clear. Company B is by far the better value. Case closed. The PEG ratio told us the real story. So we've come a long way, haven't we? We've looked at profit, we've looked at price, and we've factored in those critical growth forecasts. It feels like we should be done, but any great detective knows there's always one more door to open. There's one final piece of evidence that can either confirm everything we think we know or shatter it completely. We need to find the one thing that can't be fudged by accounting tricks. And that brings us to the climax of our investigation: cash. I'm not talking about earnings on a spreadsheet that are open to interpretation. I'm talking about cold, hard cash in the bank. This, my friends, is the ultimate test of a company's health. It's the metric that grounds all those lofty growth projections in reality. This quote says it all. Net income, or EPS, it's an accounting summary. It's useful for sure, but it's subject to all sorts of rules about when you recognize revenue or how you account for expenses. It can be massaged. Cash, on the other hand, is, well, it's just cash. Either the money came into the bank account or it didn't. It's binary. If you want the full, unvarnished story, you have to follow the cash. This is the most important distinction we'll make today. Earnings are an output of an accounting system. They're based on assumptions and interpretations. But cash flow, that's the actual money moving in and out of a business. It's different. As the slide says, earnings can be an opinion. Cash is a fact. A good detective always follows the money, and the cash flow statement breaks that money trail down into 3 distinct paths. First, you've got cash from operations. This shows if the main business is actually generating cash. This one is the most important. Second, cash from investing. Is the company spending money on its future by buying new buildings and equipment, or is it selling off assets just to stay alive? And third, cash from financing. Is it raising money by taking on more debt or by selling off pieces of the company? Together, these 3 things reveal every single financial move a company makes. Now, here's where it gets really good. When you take the cash from the core business, from operations, and then you subtract the essential spending needed to maintain and grow that business, that's called capital expenditures, what you're left with is the holy grail for value investors: free cash flow. This is the truly spare cash. It's the money that's free and clear to pay back shareholders, to innovate, or to make the company even stronger. This is the ultimate measure of financial health. So here's your practical takeaway, your actual detective kit for spotting what we call earnings quality. First, and this is the big one, is the company's operating cash flow consistently higher than its net income? If it is, that's a fantastic sign that its reported earnings are real and backed by cash. If net income is always higher, that could be a red flag for some accounting shenanigans. Second, are its capital expenditures low? A company that doesn't have to spend a ton of cash just to stay in business is an efficient machine. And finally, is that free cash flow number consistently positive and, ideally, growing? That is the sign of a true cash-generating monster. And that brings our investigation to a close. We started with that seductive but fragile earnings number. We peeled back the layers of price, of growth, and finally, we got down to the cold, hard cash. So I'm going to leave you with this one thought. The next time you see a headline screaming about record earnings, what's the very first question you're going to ask? If your answer is something like, okay, that's a nice story, but is it backed by cash? And is all that growth already priced in? Well, then you've successfully looked behind the curtain. You found the truth.